Rent is high, groceries are high, oil keeps threatening to become everybody's problem again. Companies are becoming more careful about hiring. And through all of this, the stock market keeps reaching new highs. Apparently, the economy failed housing, food, and job security, but a handful of enormous companies had an excellent semester. So either investors know something the rest of us do not, or millions of people have collectively decided that smoke is bullish. The obvious explanation is that the stock market has become one giant casino. And parts of it have. But calling the whole thing detached or irrational misses what is actually happening. Annoyingly, there is a logic to this. The market is not a scoreboard for how life feels today. It prices what investors expect large companies to earn, what interest rates make those earnings worth, where investment money is flowing, and who may be forced to buy next. Once you follow those four things, the rally stops looking mysterious. What becomes harder to explain is why anyone uses it as proof that ordinary life is going well.
Start with the S&P 500. It contains roughly 500 large public companies, which sounds like a broad portrait of the American economy. But those companies do not receive equal influence. The larger a company becomes, the more weight it receives in the index. So the S&P 500 is less like 500 companies standing neatly side by side, and more like several giants in the front row, with hundreds of smaller firms trying to appear somewhere behind their shoulders. It is technically a group photo. A few companies are simply standing close enough to block the sun. Those giants may sell around the world. They may own valuable platforms, generate enormous margins, and hold enough cash to avoid depending heavily on expensive loans. Meanwhile, renters, smaller businesses, regional employers, and people searching for work can experience something completely different. Your rent matters to the economy. It just lacks the market capitalization required to move the chart. So when the index reaches a record, it confirms that investors are paying record prices for those companies. It does not confirm that the average household has record savings, record wage growth, or record confidence. The stock market and the economy overlap, but they are not the same thing.
A stock represents a claim on future profits. That means investors spend most of their time estimating sales and cash flows that do not exist yet. They look at the present mainly to decide whether those future numbers should move up or down. This is why markets can rise before conditions improve, and sometimes while current conditions still look terrible. Prices do not react only to what happened. They react to the difference between what happened and what investors had already expected. Suppose traders prepare for an oil embargo, a wider war, and a major shipping disruption. Stocks fall before any of those things fully happen. Then the eventual outcome is delayed negotiations, limited disruption, and continued uncertainty. That is still bad. It is simply better than the disaster already built into market prices. Wall Street had booked the apocalypse and was delighted to receive a logistical inconvenience. Investors then unwind defensive trades. Short sellers close positions. Money moves back into risky assets. The world did not suddenly become peaceful. The probability of the worst outcome became smaller. Sometimes that is all a rally needs.
Next are interest rates. An interest rate is the price of borrowing money and the reward for lending it. Think of it as rent charged for using money. When government bonds offer investors an attractive, relatively safe return, risky assets have to offer something better. Imagine someone promises to give you $100 5 years from now. When safe investments pay almost nothing, that promise looks appealing. But when safe investments already offer a decent return, waiting becomes more expensive. You offer less today for the same future payment. Finance calls this discounting. The higher the interest rate, the less valuable distant profits generally become. After the 2008 crisis, and again during the pandemic, money became extremely cheap to borrow. That helped lift stocks, property, bonds, private companies, collectibles, and several digital assets created in tribute to household pets. For years, money had been available at promotional pricing. Then somebody read the terms and conditions. By the old logic, expensive growth stocks should have struggled much more. Higher rates do not hurt every company equally. A large, profitable company may have enormous cash reserves, recurring revenue, high margins, and little need to refinance. A smaller company may rely on loans whose costs reset as interest rates rise. Both companies receive the same storm warning. One of them owns the umbrella factory. That difference matters. Investors may continue paying high prices for dominant firms if they believe those companies can grow profits faster than financing costs rise. Inflation can create a similar split. You buy the same box of cereal for a higher price. To you, breakfast became more expensive. To the company, revenue increased. If the company can raise prices faster than its own costs rise, profits may hold up or even improve. Inflation does not automatically help businesses. Many companies get squeezed too, but firms with strong pricing power can pass part of the pain forward. You lost purchasing power. The cereal gained investor relations. Same transaction, two very different experiences. During recessions, wars, pandemics, or banking scares, governments often spend to prevent demand from collapsing. Some money reaches households, some reaches employers, banks, contractors, or local governments. A household receives support and pays rent, utilities, food, or debt. That money does not vanish when it leaves the household account. It becomes income somewhere else. That can protect company revenue and reduce the risk of widespread defaults. But government spending does not provide a magical stock market button. More spending and borrowing can raise inflation. It can push bond yields higher. Higher yields can make stocks less attractive. Fiscal support may protect profits while making money more expensive. It can press the accelerator and raise the price of fuel at the same time. Which effect wins depends on the size of the spending, the condition of the economy, and what investors had already expected. Again, there is no single lever marked "stocks go up." It would make the meeting shorter, but there is not. Every payday, money enters pensions, retirement plans, mutual funds, insurance portfolios, and index funds. Much of that money follows fixed rules. It does not stop to analyze the latest conflict, study oil routes, or form a personal view on monetary policy. Your retirement contribution has no geopolitical opinion. It barely knows you exist. It arrives and buys whatever the fund's rules require. In a capitalization-weighted index, the largest companies receive the largest share of that incoming money. If their prices rise, their index weights can increase. The next wave of contributions may then allocate even more toward them. The prize for becoming enormous is priority access to breakfast before the next race. This does not mean index funds can lift prices forever. Earnings still matter, valuations still matter, investors can sell. But when the largest companies already have strong profits, positive expectations, and regular inflows, the structure can reinforce their lead rather than distribute money evenly. And stock ownership itself is uneven. Households that already own substantial investments benefit quickly when prices rise. People with little or no invested wealth do not receive the same lift. They may instead watch homes and financial assets move further away from their incomes. The rally is public information. The gains are privately allocated. Profits, rates, and money flows explain why investors may want stocks. They do not fully explain why one modest headline can create a violent rally within minutes. For that, we need traders, who are not buying because they suddenly became optimistic. They are buying because their rules, losses, or hedges leave them little choice. Some funds follow price trends. Others reduce exposure when volatility rises and add it back when conditions improve. When the market crosses certain levels, those systems can switch from selling to buying automatically. The spreadsheet has detected optimism. Human participation is optional. Short sellers can create another wave. A short seller borrows shares, sells them, and hopes to buy them back later at a lower price. If the stock rises instead, the loss grows. To close the position, the trader must buy those shares back. Some of the buyers are not optimistic. Their investment thesis is simply, please make this stop. Now add options. A call option gives its owner the right to buy a stock at a set price. Dealers selling those contracts may protect themselves by purchasing the underlying shares. If the stock keeps rising, they may need to buy even more. Enough people bet on the horse, and the bookmaker starts buying the horse. Now combine trend-following funds, short sellers closing positions, dealers adjusting hedges, and risk systems adding exposure.
One small piece of good news can trigger several groups to buy at once. The headline lights the match. Positioning?
The actual market move may involve profit expectations, oil prices, bond yields, automatic inflows, short covering, and options hedging. Financial television still needs one clean explanation before the commercial break. So whichever headline arrived most recently becomes the official reason. The market produced 6 causes. The lower third graphic had room for 4 words. Markets cheer talks. Excellent. Mystery solved. Then the rally enters politics. Several giant companies rise. Index funds reinforce the move. Traders pile in. The index reaches a record, and someone stands at a podium and presents the result as proof that everybody is prospering. 7 corporations receive medals. Everyone else is thanked for making the event possible. The market never claimed that rent was affordable. Nobody asked it. That claim was added afterward, during the press conference. Sometimes, people borrow money, chase momentum, and make investment decisions based on research published by accounts with illustrated wolves wearing business suits. But the market is not completely random. It is pricing expected profits, interest rates, risk, and capital flows. It can become excessive. It can remain expensive for much longer than people expect. And it can fall sharply when expectations change. A record high genuinely tells us something. It tells us that investors currently value large public companies highly. They may expect strong earnings. They may believe the worst outcomes will be avoided. New money may still be entering the market. Mechanical buyers may be amplifying the move. That is useful information. It does not tell us whether rent is affordable, whether wages are keeping up, whether jobs feel secure, or whether the world is peaceful. Those are different questions. The stock market answered the question it was designed to answer. What are these companies worth to investors right now? The confusion began when that answer was used to describe everything else. The market can rise while households struggle because household well-being is only one part of the machinery, and often not the part moving prices today. Future profits matter. Interest rates matter. Money flows matter. Forced buying matters. And the companies dominating the index may be doing far better than the people looking at it. The number was accurate. The caption underneath it was doing most of the lying. And if terms like discount rates, market capitalization, short covering, and dealer hedging make finance sound like a language designed to keep normal people outside the room, we made a free financial jargon cheat sheet. It translates the terms into normal English. You can download it through the link in the description. Thanks for watching.